Hello, everyone, and welcome to a new episode of our Market Notes. Right now, markets are not dealing with a normal correction. They are standing in the middle of something much more complex, a rare macroeconomic breaking point. On one side, we have energy supply shocks triggered by geopolitical tensions. On the other side, we have central banks trapped by sticky inflation and confused expectations around interest rate policy. And together, these forces have started a powerful migration of capital across asset classes. So today, we will take this complex data set, the risks ahead and the possible opportunities, and place them into a calm, clear, and structured framework. Let's begin. Before we go into the details, let's first look at the full picture from the top down. Here is this week's 5-point executive summary. First, the US 10-year Treasury yield moved above 4.60%, triggering a serious global risk-off environment. Second, with Kevin Walsh taking over at the Fed, the higher for longer theme is no longer just an expectation. It has become a painful market reality. Third, in Turkey, the 2-year bond yield jumped to 42.78%, clearly exposing the severity of liquidity stress in the local market. Fourth, we are seeing a very unusual commodity paradox. Even while geopolitical risks remain elevated, gold and silver are being sold as investors rush to meet margin requirements. And fifth, on the crypto side, the historic Clarity Act has passed. But strong macro headwinds immediately led to ETF outflows. So our route today is clear. We will start from the big macro picture, then move step by step into equities, commodities, and digital assets. Markets are now trying to price more than one crisis at the same time, but this risk-off environment did not appear overnight. At the end of April, both the Central Bank of Turkey and the Federal Reserve kept rates unchanged. That created a period of waiting. But in early May, sticky inflation data changed the rhythm of the market. On May 12th, US inflation reached 3.8%. Then, on May 14th, the Central Bank of Turkey raised its year-end inflation forecast to 26%. That means central banks have very little room to move. And the accumulated pressure finally broke into the open on May 15th, with a sharp global sell-off in equities and a strong move higher in bond yields. This was a domino effect. Inflation remained too sticky. Central banks were forced into a more hawkish stance, and that created the foundation for the global market break we saw on May 15th. But what is happening inside the institutions making these decisions? That is where the story becomes even more important. At the Fed, we are seeing a structural shift. You can almost call it an intellectual split inside the institution. On one side, we have the resignation of Stephen Miran, who argued for more aggressive rate cuts and criticized existing inflation measurement methods. On the other side, we now have Kevin Walsh as the new chair, known for a much tougher stance against monetary expansion. For markets, the message is very clear. The comfortable dream of quick rate cuts has been pushed off the table, and the market expression of that hawkish stance is brutal, simple, and mathematical: 4.60%. The US 10-year Treasury yield above 4.60% should not be seen as just another interest rate. It is now one of the most important macro catalysts in the world. It acts like a giant liquidity vacuum. It pulls capital toward risk-free yield, and it compresses the valuation of almost every asset that does not offer yield. That is why the bond shock in the US is being felt across currencies, bond markets, commodities, equities, and crypto. This is no longer just about bonds. This is about the price of money itself. One of the most striking divergences is happening in silver. Let's call this the commodity paradox. From a fundamental perspective, global silver is facing a large supply deficit for the sixth consecutive year. The deficit stands at 67 million ounces. Normally, this kind of setup should push prices sharply higher. But when we look at the price action, the opposite happened. Silver fell by 7.5% in a single day, down to $75.99. So why is this happening? The answer is liquidity. In a high-rate environment, funds and investors need cash quickly to cover margin calls. And when they need urgent liquidity, they sell what they can. That includes precious metals. So even when geopolitical risk is high, the pressure of high yields can overpower the traditional safe haven narrative. Now let's move from the global storm to Turkey. The number to focus on is this: 42.78%. That is where Turkey's 2-year benchmark bond yield jumped. And this is not just a high number. It tells us something very specific. While the 10-year bond yield is around 35%, the 2-year yield is much higher. That means the yield curve is sharply inverted, and that inversion is a mathematical sign of severe liquidity stress in the system. This is the local version of the global risk-off story. The pressure from high rates is not theoretical. It is visible in the bond market. This high-rate alternative is creating heavy technical pressure on precious metals. Both gold and platinum have moved below their 50-day moving averages. That gives us a weak and cautious technical picture. When risk-free government bonds offer such high coupons, assets that do not generate yield begin to lose part of their appeal. For now, that is exactly what we are seeing. Precious metals are still important in a risk framework, but in this environment, the cost of holding them has increased. So what happens to equities when risk-free yields rise this aggressively? Bond yields begin to act like gravity. During the May 15 risk-off move, we saw this clearly. In the United States, the valuation pressure hit the S&P 500 and the Nasdaq, especially the large technology names where valuation sensitivity is high. The S&P 500 fell 1.24%. The Nasdaq fell 1.54%. But the move in BIST 100 was deeper, with a loss of 1.89%. Why? Because Turkey's extremely high nominal yields give investors a very strong risk-free alternative. And when that alternative becomes too attractive, the equity market naturally comes under pressure. Now let's look at BIST 100 from a purely technical perspective. The index closed at 14,367. That is just below the main pivot level of 14,390. In the short term, the key levels are very clear. On the downside, 14,242 is the first critical support. On the upside, 14,515 is the first resistance level. Of course, this is not a prediction of direction, but for now, momentum indicators continue to suggest that selling pressure remains in place. Now, let's move to digital assets, where a structural break has taken place. The Clarity Act passed the Senate Banking Committee with a 15-9 vote. This is a major moment. Why? Because the law defines Bitcoin, Ethereum, and XRP as commodities and gives oversight authority to the CFTC. That creates a strong legal barrier against the endless cycle of SEC-driven lawsuits. More importantly, it prepares the legal ground for national banks to custody these assets and use them in payments. In other words, a legal bridge is being built between traditional finance and the crypto market. That is the long-term story. But the short-term story is more complicated. The legal clarity is already triggering important dynamics in the background. When we look at XRP supply distribution, the picture is striking. Whales control 68.5% of the total supply. This suggests that large investors have already taken their seats at the table ahead of potential ETF approvals. But there is another side to the story. The short-term macro reality is still very harsh. In just one day, Bitcoin ETFs saw $635 million of outflows. So yes, the legal revolution may be powerful for the long term. But in the short term, the 4.60% Treasury yield is pushing funds away from risk and back towards safety. That is the tension defining crypto right now. Structural progress versus macro pressure. So, what should we watch next week? The economic calendar from May 18 to May 22 will be a full stress test. China's industrial production data will show us the direction of global commodity appetite. PMI data from the United States and Europe will help us measure recession risk. UK inflation will show whether inflation remains stubborn. And in Turkey, capacity utilization will be critical. It will tell us how much damage the 42% interest rate environment is doing to industrial activity and whether the slowdown is becoming more visible. When we put all the data together, three analytical scenarios emerge. These are not investment advice and they are not directional forecasts. They are strategic frameworks. In the base case, oil prices stabilize and BIST 100 continues to move in a volatile sideways range. In the optimistic case, geopolitical tension eases somewhat, and the equity market may attempt a fresh upside test. But in the bearish case, if oil remains permanently above $105 and global yields continue to climb, then BIST 100 could break below those critical support levels. That is the risk map for the coming period. Now let's quickly go through the 10 critical numbers of the week. 1. US 10-year Treasury yield, 4.60%. 2. Turkey 2-year bond yield, 42.78%. 3. DXY index, 909.269. 4. BIST 100 weekly loss, 4.61%. 5. WTI crude oil, $105.42. 6. Spot gold, $4,540. 7. Silver's daily drop, 7.5%. 8. The central bank's 2026 inflation target revised up to 26%. 9. Total crypto market capitalization, $2.71 trillion. And 10. Bitcoin ETF outflows in a single day, $635 million. These are the numbers behind the stress, and together they tell a very clear story. Liquidity is becoming more expensive, risk appetite is becoming more fragile, and every asset class is being forced to reprice. As we close today's analysis, there is $1 million question we need to keep in mind. Can historic and structural regulations like the Clarity Act protect digital assets from this massive macro storm? Or will global risk-free yields above 4.60% continue to pressure every non-yielding asset class? That is the central debate. In a market where numbers, expectations, and narratives change at extraordinary speed, staying anchored to macro fundamentals is more important than ever. For this week's chaotic picture, we can summarize the main themes in 3 points. First, the global storm and the new liquidity stress regime. Second, the bond shock and the Clarity Act. And third, pressure on BIST 100 together with the commodity paradox. Thank you for joining this episode of Market Notes. We will continue to track the hard macro winds and changing risks together. See you next time. If you found this framework useful, subscribe to the channel and turn on notifications. Every week, we will continue to break down the market noise into a clear macro map.